Listeners, we will get to introductions, but before we do that, Kevin, tell us something that you believe about mobile home park investing that might surprise us.
Sure, will do, Jonathan. Thanks for having me. So, mobile home parks are the only asset class that actually have a diminishing supply, meaning that there's more mobile home parks that get redeveloped or torn down or shut down on an annual basis than new mobile home parks being built in any one given year. And so, it creates a very attractive supply demand imbalance for investors.
Welcome to the source of commercial real estate, where we talk to the experts in commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I am your host, Jonathan Hayek. I'm a former public school teacher who found financial freedom through residential real estate investing, and now I invest in larger commercial properties, particularly small industrial properties. And today, as you know, I am talking with Kevin Bupp, and you probably know his voice and you've listened to one of his 700 plus podcast episodes. But Kevin is a Florida based real estate investor, top iTunes podcast host, and best-selling author with over $500 million of real estate transactions. His extensive investment experience spans the gamut of apartment buildings, single-family portfolios, medical office, self-storage, assisted living, and his two favorites, and by far most profitable, are mobile home parks and parking lots. Kevin, it's a pleasure to have you here. Thank you so much for joining me. How are you today?
Jonathan, I'm doing great. I'm excited to be here. So thanks for having me on.
Kevin, I've been a listener to your podcast in the past, and it's been instrumental for me and I know in a lot of other people's lives. So it's a thrill to talk to you, and looking forward to getting you on this side of the mic and maybe getting some things out of you that we don't normally hear. So, Kevin, why
Sure.
don't we start out by you telling us a little bit about your background, how you got started in real estate, and a little more about what your investing looks like today.
Sure. Yeah, I'll try to keep it somewhat short, but I like to joke and say that, real estate found me, I didn't find it. And so, I've been a full-time real estate investor my entire adult life. It's really the only, I guess, true job, real job, if you want to call it that I've ever had. And so, got introduced to real estate at the age of 19. Bought my first investment property at the age of 20. During that period of time, I was tending bar in the evenings, going to community college, trying to figure out what I wanted to do with my life. And again, was introduced to real estate by a girlfriend of mine. Her mother's boyfriend basically was a local real estate investor, and it was a perfect time in my life. And so I took it and ran with it. And so I bought that first property at the age of 20 with some bartending money I had saved up over the last year and a half, and then that was the start of it. And fast forward a few years, from that first investment deal, I ended up with a fairly large portfolio of single family properties. My early to mid 20s, of over 100 single family homes. Around that time, was introduced to commercial real estate. Was just looking for a scalable solution. I had bought a number of multifamily properties as well, smaller, 12, 24 unit type apartment buildings. Again, around that same time, I was introduced to commercial, and commercial, can mean a multitude of things, but I've got a taste of pretty much every different asset class over a period of time. I ended up buying some industrial, which wasn't all that sexy way back then. It was not like it is today. Self-storage, your traditional retail strip center, some office properties, some assisted living facilities. And so the list goes on. But fast forward, I was introduced. Mobile home parks never fit that list. It never was one that came across my radar. I was introduced to mobile home parks back in 2011, and just knew there was an opportunity there, and put forth the effort. Bought that first mobile home park. Ended up being 2012 when we closed on it. And fast forward to today, we currently own mobile home parks in 15 different states. Have owned in as many as 18 states, and have a portfolio of about 300 million of AUM, and the majority of it being mobile home parks. But we do have another vertical as well that we specialize in, and that is parking lots, as you'd mentioned in the introduction there. And so we own parking lots and parking garages in a few strategic cities across the country.
That is such an interesting background. I mean, you've basically done it all, and that's pretty rare, I think, in the real estate investing world. So, what was it about mobile home parks that stuck for you?
Yeah, it's a great question, and I will say that throughout the throughout the trial period of buying these different assets. And I wouldn't, when you say you've done it all, like I didn't have big retail portfolios and I didn't have big office portfolios. It was kind of like trying to dip my toe in the water, buying things. I was always a value add investor, finding where I felt there was opportunity for me to improve upon the current business model, whether it be fill vacancies, do capital improvements, what have you. But I always kind of circled back to, the multifamily stuff I had, the smaller multifamily properties I had, it ran a lot more efficient than my single family home portfolio. And it just, that business model that everyone needs a roof over their head, like that just always made a lot more sense to me. It was just easier for my small little brain to actually to understand. And so mobile home parks just really were an extension of that. When I kind of look back and took a view of all the things I had invested in, the good, the bad, the ugly, what I liked about it, what I didn't like about it. Really residential always rose to the top, and more specifically multifamily. Again, it's so easy to understand, especially if you're in a market that has got a growing need for affordable housing. Most of what we always did was workforce housing, which is very akin to what we do today. And so mobile home parks were they seem to be a perfect fill for that void. In fact, what I have really come to find out is like you can take any community that we own in any state across the country, and our product that we offer, it is by far the most affordable product in that marketplace. And so that would be assuming that, hey, I need to find a place to live with my family. Your options are, if you're a renter, is rent a house, rent an apartment, or rent a mobile home. Those are really the three options. And house is pretty much out of a lot of folks' reach that live in our communities. They don't have $3,000, $4,000 a month. And so really what it comes down to, if you want to compare apples to apples, like me, we're really probably more comparable to like a B plus class apartment community, something that was built maybe like in the 80s and 90s. In any city that we own in, I guarantee our homes are probably 25 to 30% cheaper than that of the comparable size apartment unit. But along with that, you get benefits. You get your own yard. You don't have a neighbor beside you, above you, that's pounding on the walls or vacuuming in the middle of the night, right? Like you kind of have the sense of a single family home, but at a price point that is lower than that of a traditional apartment unit. So it's an incredibly affordable option. And the product today, what a lot of people perceive mobile homes to be is very different than what they really are. The quality of the product has become so advanced. A lot of the materials that are used are the same materials that are used in stick-built homes. They just happen to be built in a controlled environment in a factory and then transported, to the site. And so you get a lot of bang for your buck. And again, a lot better or higher quality living experience than you might get in a traditional apartment complex.
Kevin, I'm thinking about your background in dabbling in lots of different asset classes, and I'm thinking about maybe a beginning investor who's thinking about, the sky's the limit. I could invest in mobile home parks or self-storage or single family homes or multifamily or industrial. I could do anything. What sort of advice do you typically give those types of people? Do you tell them, hey, you need to pick something and focus, even if you don't stick with it long term, just focus? Or do you tell them, hey, you know what, when I was getting started, I dabbled a lot and it got me to where I am today? What sort of advice do you have for people just thinking about getting started?
Yeah, I mean that's a great question. Focus today. I mean, like we're so laser focused. In fact, it took speaking to mobile home parks and then parking, right? Those are the two verticals that we're in today. We parking came across our radar probably back in 2017, maybe late 17. And it was so intriguing to me, but yet I was not willing to get out of our lane. I was not willing to, chase that shiny object, but we researched it, we studied it, we went to conferences, but we didn't take our eye off the prize, which was mobile home park. That's what we were really good at. That's what our core competency was. And that's, you only get better over time. And so we didn't want to dilute that focus, but, on the side, we weren't comfortable enough to go buy it. Parking, that is, but we wanted to learn as much as we could about the industry, learn who the players were, and it just really confirm our initial thesis that we think it's a great asset class that's underserved, and it's a very fragmented market, and it could be an opportunity for us to expand upon it. But not until 2020, late 2020, did we actually buy that first parking property. Many deals came across our desk, and it just wasn't good timing. It just wasn't a good time to truly bring another vertical in, because it just adds confusion to the organization. It again dilutes focus, and we didn't want to stunt our growth and just the business that we had already built in the mobile home park sector. So anyway, back to the original question is focus. That's it. I mean, literally, real estate's just a vehicle. I mean, maybe you can find that you've got a certain passion for, whatever, maybe you can find that, hey, like I love industrial because, whatever it might be, whatever, like I feel that it's a better alignment. Maybe it's the tenant base that you're serving there. It's just, maybe you grew up in a manufacturing family and you spent a lot of time around warehouses, and like, that's kind of in your blood. And so maybe that's why industrial could be the way for you to go. Or, maybe your great grandfather developed multifamily properties, and like it's just you've heard stories of him building communities for families and their children, and maybe that's it. So maybe you can find an alignment of passion in a particular asset class. But if you can't, I will say that you can make money in all of them. I mean, you really can. I mean, like I like to say that mobile home parks and parking are literally, I think for many reasons they're better than a lot of the others, but I'm sure you can make a case as to why industrial probably has advantages over maybe some of the things that I love about mobile home parks, right? And so it's not he's right, I'm wrong, or vice versa. It's pick an asset class, pick a vehicle, and then focus on it. Double down. Take the time to understand it. Take the time to understand the players, the markets, the submarkets. There's so many unique nuances with each asset class that it takes time to become an expert. And it's very difficult to do really well when you're scattered amongst many different types of properties. And there's companies out there that do it. There's companies out there that have big holdings. But my guess is, if you dug a little deeper, and they're a successful large scale company, they probably started somewhere. They started with one, and then didn't really layer in additional verticals until they had a sound foundation.
Yeah, great advice. I think really, really solid advice right there. Kevin, will you tell us about a little more about Sunrise, and more specifically the deals that you're doing? So I'm interested in your buy box. So in terms of mobile home parks and the parking lots, what sort of deals are you looking for?
Yeah, so in the mobile home park space, I'd say I guess from a size perspective, the smallest deal we're really considering today is about 100 sites. The bigger, the better for us, just as far as efficiencies and scalability. We'll buy, for the most part, anywhere in the Southeast, with exceptions being made for just, rural, very rural areas, certain states like Louisiana, Mississippi. There's really not a lot of economic stimulus happening in those areas, but there might be a few select cities that we would still consider. But so Southeast, for the most part, everywhere, except very rural locations. Northeast, we basically love most red states, try to stay away from the blue states, New York and pretty much most of New England, we just steer clear of. New York, we don't invest in any longer. So, blue states are pretty much off the radar for us, but there's a few nuances there. Like, for example, we own in Illinois. Illinois is really known as a blue state, but most of that's because of the concentration that exists inside of Chicago. For the most part, the remainder of the state of Illinois is very much a red state. And so, so long as we can stay away from the politics that come along with the blue and the lack of support for landlords, we'll consider investing in those areas. But that's on the mobile home park side. I mean, I'd say our average deal size, probably ranges from about 5 million on the low end, and we've purchased individual single communities for as much as 40. I think our biggest mobile home park deal, standalone one deal, was $46 million. That was a very large, nearly 800 unit community. And then as far as on the, and then we'll also buy in some in the Midwest as well. So we've got communities in Michigan, we've got communities in Wisconsin, Minnesota, Ohio. And so we like the Midwestern states as well. Lots of stability, economic growth. And again, really for us, does that market, the core of it is, does that market have a demand for affordable housing? So a lot of times we're looking at median home prices. We want to see that median home prices are north of 200,000. The higher, the better. We want to see that median, 2-bedroom rents are above $1,400 to $1,500 a month, and 3-bedroom rents are, nearing or over $2,000 a month. And then population, ideally 100,000 population or greater. Again, the more population density, the better. And it's probably the extent of the general buy box again. And then you start diving into like more granular details on our buy box of like utilities, like private utilities versus public utilities. And we own all the above. We own communities that are on private wastewater treatment plants, or they operate on wells for the water. And that's where a lot of the uncertainty kind of comes into place for us, or the questionability of whether or not it's a good opportunity. If everything else fits that buy box, we have not bought many deals because of the infrastructure arrangement. So hopefully that answers your question. And as far as the parking stuff, parking's unique in that we're somewhat agnostic, geographically speaking, but most of what we own is in urban core areas. And so there's really 5 demand drivers that we're looking for in parking. As far as like where are the people coming from that need to park their cars there? A lot of parking in the United States, a lot of it was purpose built, especially in urban core areas, to support office buildings and office workers, and then all the other transient and other supportive businesses around that. But a lot of the concentration in a lot of areas had historically come from office, and that's one place that we don't have an interest in being. We don't want to have any reliance upon office workers ever coming back more than to where they're at today. And so it automatically nixes a lot of what it could have been an opportunity for us in the parking. And so really five demand factors. And the 5th one can be office, but it's got to be literally like 10% or less. And so you got government buildings like courthouses, and any other type of government support buildings. You've got hotels. You've got just, retail, transient traffic, and then you got events, whether it be football stadiums, baseball stadiums, concert venues, what have you. Those are really the primary 4 that we're looking for. And the 5th can be office, but it's got to be such a small version, or the small portion of the overall demand function of that parking facility. So, and outside of that, we'll pretty much go anywhere. There's a few cities that are a little more challenging to operate parking in. Chicago is, it's got a very egregious parking tax, and it seems that somewhat it's mob operated to a certain degree. It's kind of one of those places where, like, if you don't know that, if you're not like in the family and know the families and have agreements with politicians, then you probably won't survive there, or you actually won't be successful and profitable. And the same goes with like urban New York City as well. Kind of the same idea. So we try to stay away from some of those, larger politically driven cities. But like, Tampa Bay, we love Tampa Bay. We own stuff in Phoenix. We love those growth markets that have a lot going on, but are, less influenced by outside factors like, again, Chicago and New York City.
I am a product of the suburbs of Chicago, and so your comments about Illinois and Chicago are 100% spot on. It is, I haven't lived there for over 10 years, but from my experience growing up there, your comments about the region are totally spot on. I want to spend just a minute or two on parking and the rest of our time on mobile home parks and building your personal business. But with your parking lot strategy, is it a cash flow strategy? Is it sort of a covered land play strategy in the path of progress with the hopes to sell to a developer at one point, or a combination of the both, or what is the strategy with parking lots?
All the above right there. And so when we underwrite something, it's got to make sense today as parking. It's not just just a cash flow covered land play to where like we're just going to break even and we're going to hold it because we have intent to redevelop it in the future. We're not developers. However, with that being said, it's got to first and foremost make sense as a parking play. Hands down, it's got to meet all of our buy box criteria. It's got to meet our returns for our investors. And so that's first and foremost. But second to that, we have to have a very good understanding of the market and feel very confident, supported by data, that there inevitably will be a higher and better use at some point in time. But as of today, the lowest use being parking still makes sense as parking. The lowest use today is parking, but we've got air rights and we've got an opportunity to redevelop in the future. Should we choose to, or should we choose to sell to a developer? But we don't underwrite that icing on the cake. We kind of just look at it literally. It's like added value, but we want to know that the opportunity absolutely exists. It's in a path of progress. It's growing like gangbusters. We know that parking supply is continually getting diminished in inner cities. A lot of the new developments. A lot of cities have removed the parking minimum requirements for developers, and so they're not building excess parking. A lot of surface lots are getting redeveloped into mixed-use properties, hotels, you name it, right? Multifamily properties. And so we just want to know that it's got demand today. That demand's going to continue there for, it might be 5 years, might be 10, might be 15, might be 20, and we'll hold it, for as long as the demand, can suggest parking is the highest and best use. And then at some point, in the future, we'll either sell to a developer or we'll partner with the developer or just redevelop it ourselves. But we don't underwrite that. We don't put any value there. Really, we don't put any monetary value today. It's not part of the underwriting or the evaluation or how we come up with our offer price.
I love hearing about that. I think you're the first person to ever have this parking lot strategy that I've had on the podcast. So love hearing about that. But in light of our previous discussion about focus, I would like to switch to mobile home parks. I think that's what your kind of what your greatest knowledge base is and what you're best known for. So I want to ask you about adding value to mobile home parks. I saw, as I was preparing for this conversation, I saw a post from you on LinkedIn showing that you recently opened a swimming pool at one of your communities. Mm-hmm. And so I don't know if that's sort of in your wheelhouse of typical strategies that you do, but what are some typical value add strategies that you're looking at when you're looking to purchase a mobile home community?
Yeah, and I'll speak to that one real quick. I would say that we don't typically go in if the community didn't have a swimming pool prior. We won't go in and install a swimming pool. There's just there's a lot of costs associated with the swimming pool. There's a lot of liability, added expense from even repairs, maintenance, all the way to insurance. And so, however, with that being said, in this particular case, this is a community that we purchased at the end of last year, December of last year. It's very much a value add play. There's a number of improvements that we're going to be making throughout that community. But one of them was they have a big clubhouse there. They have a big community center, and they had a swimming pool, and the swimming pool it needed some repairs and had not been in operation for the last 2 years. And this is a very large community. This is the one I mentioned. It's over 800 residents that live there, lots of families. And so in the summertime, I mean, this was their summer reprieve, was being able to go to the swimming pool, and it hadn't been open for 2 years. So they're paying the rent on time. They're getting rent increases on an annual basis, and they're doing what they're supposed to be doing, but they're not getting the amenities that they're paying for. And so we immediately, that became one of our big CapEx plans. We wanted to, get it up and running prior to the summer months hitting. And as you'd mentioned, we just opened it up here a few weeks back, and then we're doing some major renovations to the clubhouse there that's attached to the pool area, that will allow residents, which they had historically not been able to do, but come in, utilize the space for birthday parties, for special events, family reunions, things like that, and just, again, be able to leverage the amenities in the community. But outside of that, as far as like value add pieces, operational inefficiencies are huge in our space, especially when we're buying from like an older operator, mom and pop. A lot of times we'll find a lot of areas in their profit and loss statement that are just, there's a lot of fat that can be removed, whether it be from a payroll perspective. Maybe they haven't reshopped their vendors in quite a long period of time, all the way down to, water and sewer charges. A lot of communities built a long time ago, water and sewer charges weren't that expensive. So a lot of times historically that was just included in rent. And it's become just out of control, the cost. And then there's also a lot of abuse when residents don't pay for their own water and sewer. They tend to abuse it and don't really monitor if their toilet flappers are running, if they're washing the car 10 times a week, if they're taking hour-long showers, right? All those things. And so we'll go in and put individual meters on each one of the lots, and then we'll bill back for each month, each resident's respective usage, and allowing us to a lot of times eliminate a six-figure charge or expense, from the P&L. Outside of that, we do a lot of capital improvements. Like we'll put a lot of brand new signage in. We'll do a lot of landscaping. A lot of times trees are deferred. Folks just, it's a painful expense every year, every couple of years to spend, $30, $50, $100,000 on tree trimming. And we find that that's one of the most commonly neglected things in these mobile home parks. Trees are beautiful, but they start becoming a nuisance. They have heavy limbs, they cause damage, they drop limbs everywhere, they drop leaves everywhere, or they just simply haven't been trimmed, or dead trees haven't been removed. So we'll go in there and spend a lot of money on those types of things. We'll repave roads. That's another area where a lot of operators tend to skimp or not reinvest money back into the community. And then, last from that is infrastructure. So, I'd say more rare than not, if we have to go in and replace water lines throughout our community, if they're really old water lines and they're causing, challenges with the water, with staining and things like that, or sometimes sewer lines. But so just lots of aesthetic improvements, but as well as lots of infrastructure things, roads, sewer lines, trees, things like that. And then outside of that, I would say in very select communities, it really depends on the demographic that we're serving. So like we try to really understand like who is it? Is it an older population? Are there, a lot of kids? If there's a lot of kids, then, we tend to put playgrounds in, really nice playgrounds for, families to go enjoy themselves. If it's not that, if there's not a lot of children, we won't put a playground in, but we might put a pickleball court in. We're actually putting a pickleball court in one of our communities right now up in Ohio, but it's predominantly an older population, and not many young families with kids in the community. And so we surveyed the residents, gave them some ideas, and pickleball was what they chose. It was like overwhelmingly pickleball. And so we're putting a pickleball court in there. And then outside of that, just some common barbecue areas, grills and pavilions and things like that we'll put in as well, where it could be a centralized communal area that can be used by residents.
Kevin, I want to ask you about deal finding next. And I think kind of an, I don't know, funny, haha, or interesting anecdote was I think I first learned about you and your podcast through a reference Brandon Turner of Bigger Pockets fame made. And he referenced kind of a deal finding strategy that you had with your listeners. I think bring Kevin a deal or something like that. And so he copied it. And, then he made bring Brandon a deal. And I'm sure he brought, all kinds of interest to the mobile home park space. But that's how I found out about you. And as I listened to your podcast and sort of just pay attention to you on social media, a lot of what you're trying to do is generate off-market leads and off-market deal flow. And so I'm curious about some of, as mobile home park investing has gained, much more popularity over the last decade or so, what are some of the most, I guess, capital efficient ways of finding deals that you have found? I assume you're finding most of your deals through off-market means, and correct me if I'm wrong there, but talk about deal finding and maybe some strategies that are working for you and how it's changed over the years.
Yeah, no, it's a great question. I would say if you'd asked me that question, probably 4 years ago or even 3 years ago, I would have said that 99% of everything that we were buying and everything that we've historically purchased within our portfolio was off market or off market direct to owner, relationships that we've established for many, many years. You asked me that question today, I would say it's probably closer to a 50-50. We have a lot of relationships that we've established with owners that we've literally been talking to, calling on for many years now. Some we closed a deal 2 years ago where we had been talking to that guy for, 8-9 years, quite some time. In fact, we're closing a deal. I think it's going to close next week. Probably about 8 years talking to that guy on and off over many, many years. And it took just that long to get the timing right with him and to get him comfortable with that. We're the right buyer to take on that. It's a kind of like for him both of them was family legacies, right? Like they want the money, but they also want to ensure that they're selling it to the person that they know, like, and trust. And that's going to kind of carry on what they perceive to be their legacy, something that they've spent the last 40, 50 years running. And so again, back to the original question, 50-50 of broker relationships to direct to owner off market, transactions. And as far as what's really fueling those off market transactions, we don't do any more direct mail. We used to do that a long time ago. And that, I think that's, direct mail and a lot of cold calling initially established kind of the, maybe the original introduction we had to a property owner. And then we just really have honed in on our database, our CRM over the last, 5-6 years. We know literally, the 500 or 600 parks that really fit our buy box in certain regions that we want to buy. And we're not calling on like 5, 6, 7,000 people all the time. Like we know exactly who we want to spend time with based on, we know that at some point they're aging out of these assets. We have a general understanding of what their succession plan is. They're going to sell, they're going to pass it on to their kids. Like we have all those notes. And so we really only spend the time on those because we feel like those are the best opportunity for us to work with the seller directly versus them taking it to a broker. And so the other half of it's a broker, just again, like a lot of other industries, it's broker relationships, ensuring that brokers know that not just we're buyers, but that we can close. And I would say that that's really, we've been able to somewhat prop ourselves up over the past year and a half on somewhat of a pedestal, because a lot of buyers stopped buying the last year and a half, or they couldn't buy. Their liquidity dried up, and they just found themselves in a scenario where they were on the sidelines. Maybe they're managing their current portfolio because maybe they paid really aggressively for some things, or have debt maturities looming, or floating rate debt that they're kind of trying to manage through. So a lot of it was like, just focus on what we have. Let's not buy more and lump it on top. But we were here raising our hands in the past year and a half saying, we're still buying. We're in a good position. We didn't buy a lot during 2020, 2021, 2022. We've never missed a distribution. We've literally made our 27th consecutive quarterly distribution to our investors. Never stopped distributions, and at our really low leverage point across our portfolios, and have no floating rate debt, no debt maturities looming or anything like that. And so we were in a really good position the last year and a half to buy, and that really made us stick out quite a bit more throughout the brokerage industry, because as you and I know, brokers, all they really care about is that the deal is going to get to the closing table and they're going to get their commission check, right? Like, that's really what's top of mind for them. And so we've become known as the group that will not just tie up deals, but we'll get them to the closing table.
And that leads into, I guess, my next question is fairly open-ended of how's business? How,
Yeah.
you alluded to the last 18 months being difficult for many, maybe not for Sunrise. So will you talk about, if you're actively buying deals, if you're actively selling deals? Are you active right now?
We are active. We had, as far as like from an acquisition standpoint, we last year was our largest year as far as volume, or I guess AUM, whatever, however you want to look at it.
That's amazing.
We acquired close to $100 million of assets last year. This year we have got a really stout pipeline. We've only closed one deal yet this year, in the beginning of the year, and then we've got a substantial pipeline that we're working through right now. But business is good. I would say that the fundamentals of how we underwrite deals and what we look for, the returns, that hasn't changed, and so it's become more challenging where rates are at. A lot of deals that come to market still don't have a reality check of there's got to be some type of spread in there. If we've got a 7% rate going in, and they're trying to sell it at a 4 cap, and there's just not a mountain worth of value add that we can get to right away, then the deal just doesn't make sense. We can't make it work. And so we look at we make a lot of offers. But we're finding that what I'm really finding is that you asked me if we're selling. We're not selling anything because it's not the right time to sell. We don't have to sell. We don't have any debt, challenges. We don't have any investor challenges that are looking for their liquidity back right away. Like, it's just, we're not in a position to have to sell. And so in today's world, unless you have to sell, you're not selling. You're going to hold off and wait for some stability to come into the marketplace, for rates to maybe, see a couple cuts and see, just confidence come back into the market, and hopefully stabilize the values, because real estate across the board's dropped quite a bit. Some sectors more than others. And so, no, we're not selling. And I believe that anyone that is selling today, maybe it's not super distressed or motivated, but there's some type of motivation, underlying motivation that's pushing them to sell. We just need to uncover the right deals at the right price that we can still make work based on where rates are at today, and what the property is currently selling. And I believe that a lot of things that we actually have in contract, or that we bought in the last year and a half, we bought at a true discount. At a significant discount to what peak pricing was, but even then at a discount as a result of whatever distressed situation that seller was going through. And these aren't distressed deals most of the time. These are distressed partnerships or situations, not necessarily distressed assets that are underwater, or have major occupancy issues and things like that. So business is good. Business is really good. I mean, we're being very strategic right now, and somewhat aggressive. Not aggressive from pricing, but just aggressive of, like, now's the time to run. Like, the old Warren Buffett saying, be greedy when others are fearful, and be fearful when others are greedy. I think the time to be fearful was 2020, 2021, 2022. And then as we started, seeing these rate hikes go up, everyone's pulling back, everyone's slowing down, everyone's, I've got floating rate debt. What's going to happen now? Right? Like, everyone's in damage control and just trying to maintain. And a lot of folks have just, again, stepped to the sidelines, either by choice or being forced to the sidelines. And I think it's just, we're in a really good position to grow, and and it's been a fun run. So I'm excited for what the remainder of 2024 has in store for us. And again, I think there's going to continue to be good opportunities. And I would say for anyone that's out there, I mean, like, you can't time the cycle, and I'm not one to tell you that we're at the bottom. You just got to read the headlines, see what some of the other big PE groups are doing. I think I saw something come out today that Goldman Sachs made a statement that they think we've hit kind of the bottom of the office market. I'm not going out and buying office, but like, if you're one of those guys, if you're optimistic that it truly is the bottom, you can pick these things up for 10 cents in a dollar. Like, there could be opportunity there, right? There was another big PE group. I think maybe it was Blackstone a couple of weeks back that had suggested that, they feel like the bottom we've hit the bottom in the multifamily space, and like they're starting to deploy a significant amount of capital. Like, all those guys are way smarter than I. And like, we try to look at those as like lead indicators, maybe not like take it face value, but just pay attention to what these bigger groups are doing, because they've got tens of millions of dollars of payroll of analysts and folks, economists and doctorates that are studying the market, that are studying the economy and making educated guesses as to what the next step is. And so, anyway, that was a long-winded answer to your question, but business is good.
The fact that 2023 was your biggest year ever is amazing, and I think I think that's it says a lot about Sunrise as an organization and you as a leader. The fact that you were prepared for it, and we don't know how these deals end, but the fact that you have as much experience that you have, and you felt good about landing those deals. You were able to get the debt, the equity, and the broker relationships, and were able to close over $100 million in real estate in 2023 is pretty amazing, considering I don't know that anyone else. I know I haven't talked to anyone else in real estate that had their biggest year ever in 2023. So I think that says a lot. Will you talk about what you're experiencing in the debt and equity space? So your relationships with lenders, their appetite for lending on deals right now, and your relationships with high net worth individuals looking to place money into syndicated deals right now. What are you experiencing?
Yeah, as far as from the debt side, there's definitely still plenty of money on the debt side, at least for both the asset classes we're in. Mobile home parks, agency, the government backed lenders are, that type of financing is available. So Fannie Mae, Freddie Mac, will lend on mobile home parks. It's the best, typically the best terms within our industry. The same thing goes with multifamily. They're still actively lending in the space. They might have scaled back a little bit as far as kind of their pricing, like from a loan to value perspective. Like, it's probably down about 50 basis points. Whereas, like, historically, if you could maybe push it to a 70% LTV, you might be capped at a 65% LTV, but they still have the typical 1.25, debt coverage covenants in the loan. But outside of that, they love the space. They're aggressively lending in it. We have not had any deals that have been turned down by either Fannie or Freddie in the past year and a half. Banks are, regular, regional banks are still lending in the space. Very few times do we actually work with regional lenders. There's here and there we do. It's really dependent. It's got to be a deal that that just really doesn't fit the box today for Fannie and Freddie for us not to go that route. Case in point, we've got a 3-part portfolio we're buying right now. Fannie and Freddie really want to see that it's at minimum 70% occupancy across the board, ideally 75. This one's literally like 69. And unfortunately, it's a big infill project. So we're going to buy brand new inventory, bringing about 80 homes over the next 3 years. And it's just not a good fit for them right now. It will be when we're done with our turnaround, and once we infill the homes and get it stabilized, then we'll do a cash out refinance with the Fannie or Freddie loan. But debt has not been a problem whatsoever. Rates are higher, but that's not a problem. As far as the equity side, it's hard to say. I mean, we had a big year last year. We closed out 2023 with a bang. A lot of investors tend to make tax influence decisions on the investments towards the end of the year, looking for additional write-offs. And so I would say that our capital raising has been a little slower in the first 2 quarters of this year than it was in the last 2 quarters of last year. But it's hard to say whether or not that's broad brushstrokes across the board, and it would be like that the remainder of this year, or else we'll see another ramp up towards the end of this year once we're looking to close out the year and folks are looking for tax benefits. But I mean, we haven't raised capital as fast as what we had been able to do in 2020, 2021, and 2022. But with that being said, we haven't not been able to do a deal because we weren't able to bring in enough equity to get it done. So ask me that in 6 more months. We'll see. We got a pretty big pipeline right now. Let's follow back up at the end of the year and see how it all wrapped up. And I feel pretty optimistic. Again, just more importantly, based on the track record, like I said, we just had our 27th consecutive quarterly distribution that we made to investors. So we're in a really good position on all of our historical funds that we've done. We've done full cycle on 16 different deals. We've got 2 of our 4 funds have had a full return of capital and literally still own deals today and are just making distributions on a regular basis to our investors. And so we're in a really good position. And I think that really folks are like they're making flights to safety if they're looking to place equity in real estate. And I think that it helps us stand out. We can just kind of, stand on our laurels and just show what we've done, not talk about what we've done, but just show what we've done and give confidence that we're a good bet for the future as well.
Kevin, we're getting towards the tail end of our conversation here, and I want to just ask you a couple questions about your personal brand and building your business and how that's contributed to Sunrise and your deal flow. And so you're very active on social media. You have at least the one podcast. You might even have multiple podcasts. So first, I want to ask, what does your team look like today?
Yeah, so we've got the investment company, which is Sunrise Capital Investors. On that side of the house is where we have our finance team. It's myself and one other partner. So he and I are the principals of the company. We got an acquisitions team. We've got 2 analysts on the team. What else do we have? Investor relations is probably a big part of our organization. All of our capital comes in from retail investors, so high net worth individuals, and so. As far as one department that's probably got the most folks in it is our investor relations team, from, top of the funnel, bringing leads in to qualifying leads. So we've got a couple sales folks that basically, work with our investors that they're looking to make investments with us. And then we've got kind of a support team on the backside, just working with existing investors with questions, getting quarterly reports out, K1s, all that kind of stuff. And so to answer that question in a better way of like how many folks are on our, how many folks are truly on payroll on that side, I think it's somewhere like the 20-25 person range on our investment company. And then we've got Sunrise Communities, which is our property management company. So we manage all of our manufactured housing communities. We manage all those in-house. And I'm just taking a stab in the dark there. So we've got like an operational team. And then we've also got individual on the, within these communities, we've got community managers. Sometimes the bigger communities have maybe an assistant a main manager, assistant manager, and maybe even a salesperson there on staff. But I'm going to take a stab in the dark and say on our Sunrise community side, we probably have about 50, maybe 60 folks on payroll, something along those lines. Mostly all in the field, all out in the field and in trenches, like traveling to communities, handling construction, CapEx projects, and all the above.
Will you talk about your activity through your podcast and feel free to talk about your podcast and plug it and also your activity on social media. What is the strategy there? What has your activity in your podcast done for you personally or your business?
Yeah, it's a great question. I technically have 2 podcasts. So the top, if you're watching the video, you can see Real Estate Investing or Cash Flow is my primary one. I launched in January of 2014, so I've been running it now for over 10 years. That's our primary show, and then Mobile Home Park Investing Podcast. I launched that. I believe I have to look back. I think I launched it in 2016, and then we actively produced that show. I think for 3 years. I think 120 or 130 episodes. And then it's still out there. You can still go listen to it. A lot of it's still very relevant even today. A lot of it was very actionable type details of our business. but it got to be too much. As you know, hosting a podcast, it's a lot of work. And so hosting two. However, we just agreed a couple of days ago that we're actually relaunching the Mobile Home Park Investing podcast. So the team wants to relaunch it. So we're going to bring a couple other folks from the organization in to help relaunch it on a regular basis. But as far as what it's done for the business, I mean, it's really hard to quantify that. And I didn't start either one of those podcasts thinking that I was going to get a return on the business or was going to help us grow. And honestly, the original show I started because back then, prior to folks like you getting in and other, like there really wasn't any real estate shows that talk to commercial real estate at all. As far as investments in commercial real estate, it didn't exist. I think the Real Estate Guys radio show was out, and they kind of run the gamut on everything. And it's a great show, but that existed. And outside of that, most of it was like fixing and flipping, wholesaling homes, all that. Like that was most of the real estate shows. And so I got fed up. I was an early adopter podcast. And so I was like, well, if no one else is doing it, I might as well, if all that comes out of this is that I get to interview really cool people, ask the questions I want to ask, and then other folks on the other end, there's got to be a number of other folks like me that will get some value from it. If that's all that comes of it, then, I would deem it to be successful. And as a result of it, as you know, like you get listeners, you get folks that understand who you are, your business, they can relate to you in different ways. And from that, after a couple of years, we had folks kind of reaching out, hey, like you're talking about what you're doing, these different deals. I would love to invest with you. Are you accepting capital? And so we didn't formally even leverage it as a business tool until I guess about probably 3.5 years in. We launched our first fund, in 2017, and actually started leveraging the podcast to actually raise capital. But so it's had a phenomenal impact on the business. As far as how to even quantify that, it's very difficult. Whether it's my podcast or it's me being on another show, it's just very difficult. But I would say that it's been a key driver in the growth of our brand, which that brand has helped us attract, great limited partners, great partners that bring capital to our deals. So, and then the Mobile Home Park podcast was somewhat unique. I think that one also had a great impact, but in a different way. We used it a lot of times, and we still do, if you're considering investing with us, tell you what, instead of me telling you how good we are and I can show you data, just go listen to that show. Like here's 20 episodes that we go into detail about a case study or granular details on the operation side of the business, how we do what we do. Just go listen to it, and you can hear us talk about the business plan in detail, and I think that helps folks. That's helped folks get a lot of comfort of that we know what we're doing. We're not just talking about it, but we're actually going through case studies, and then you tie it back to like the performance, and we can show you data on like, hey, we're consistent. We know what we're doing. And I think it's just the entirety of that has really helped folks gain a level of comfort and trust within our organization. So it's been a big piece of what we do.
As you look back to when you started your podcast in 2014 and as you continue to build your brand, any mistakes that pop out as you look back on how you started out 10 plus years ago? Any major mistakes pop out to you?
On like the podcast, you mean? Like what would we have done differently? Or
so anything in terms of building your brand, building your business, or in the podcast?
Not necessarily in the podcast. I mean, you kind of learn and you try new things, and we never had one thing that I guess truly stuck out. I mean, I think one thing I didn't know was a mistake until it was a mistake. We used to have both of our shows. If you typed in real estate investing or real estate in iTunes, like we would have like the number 1 and 3 spot for many, many, many years. And then there was an algorithm that changed in iTunes, and it picked up on 2 misspelled words that we had in both the show's show notes. And so instead of the word shift, the F was missing in one of them, and I forget what the other one was. And they literally took our shows down for like 3 weeks or a month until we could actually get them back up. I don't know how we would have fixed that. Maybe done a more thorough job of spell correct or what have you. But like that, we lost ranking. We ended up back in like 15 or something like. So we dropped the number of rankings for whatever that's worth. I don't know. So that was only one big impactful thing that really affected, I guess, the ratings of the show. But we didn't see really the downloads change all that much. The downloads continued on. I would say going back in time, the different platforms we're on, I wish we would have taken the time 6 years ago, 7 years ago to put more of an emphasis on YouTube. I think there and there still could be a lot of opportunity there. It's just really hard. Just like in the podcast space, it's really hard to stand out now. There's thousands of them get launched every day. Same thing with YouTube. It's really difficult to like stand up on the throne. But I think if you were an adopter 6-7 years ago, and you put the energy there, I think it would have paid dividends. Standing here today talking about it.
Really great stuff, Kevin. I'm very appreciative of you spending your time with me today. This has been a great and worthwhile conversation. If listeners want to connect with you and learn more about you and learn more about Sunrise, where would you like to send people?
Yeah, you can go over to investwithsunrise.com. It's our, Sunrise Capital website. But there you can also, we've got some free reports. We've got a parking lot investing report. We've got a mobile home park investing report. But on top of that, we even have a lot of additional details on existing deals that we own today, historical deals we've done. We've got case studies up there. We even go as far as posting like appraisals of properties and just, more granular details so you can get a better understanding of what we're buying, why we're buying it, kind of the story around it, and then how we make money out of it. So just lots of good information there.
And of course, don't forget the podcast. It's Real Estate Investing for Cash Flow. I looked at it recently, over 700 episodes, which is incredible. So a ton of expertise there. Kevin, thank you so much for joining me today.
Jonathan, thanks for having me.
Listeners, if you enjoyed this conversation, feel free to reach out to either one of us. We love talking about commercial real estate, and we would love to connect with you. Come back next week for another great interview. Thank you so much for listening. Until next time.